You think that people could sit there and play slots for hours if there was the emotional risk? If there was the emotional risk that traders have about if they're wrong or they lose, they're going to tap into that pain. People, we don't enjoy that. It has to be enjoyable. The emotional risk of playing slots for most people just doesn't exist. They're enjoying themselves because they know the outcomes are random. They know they cannot, it is senseless, it would be an effort in absolute futility to think that they're going to predict what the pattern of those wheels are going to come up with on the next spin. They might not know anything about the architecture of the computer chip that generates the random outcome, but the point is, it is a purely random outcome. And when we learn that it's purely a random outcome, the whole idea of predicting or even being right or wrong is irrelevant. It doesn't apply. Does not apply. And so it takes what we're doing, the activity, out of a right or wrong context. And so I can sit there and push the button, and there's nothing to be right or wrong about because I'm not predicting the outcome. Now, that's a little bit more tricky in trading because we're using an analytical process to actually make a prediction. But what we have to do is we have to apply the principles of the law of probabilities on that prediction and say, you know what, this is a prediction, correct? Okay, I mean, this is, yes, I am making a prediction. You know, I don't have any illusions about the fact I've used this in an analytical process, I've come to a conclusion, I'm making a prediction, but you know what, it's still just a guess. And in that way, we're not responsible for what the market does after we put on a trade. How can we be? When you understand order flow, when you understand there is no way that I can predict the intent that other traders have after I get into a trade. There are other traders all around the world waiting to enter orders for whatever reason pops into their brain. Whatever agenda they have, whether it's commercial, whether it's contractual, whether it's hedging, or whether it's pure speculation, they have their reasons for sending a buy or a sell order to the exchange, and how big that order is. There isn't anything that we're doing from a technical or even fundamental perspective where the mathematics of our system can predict what those guys are going to do, or women, okay? There's just no way. In essence, I'd have to know who's about to send an order to the exchange, what kind of orders are going to be. Is it going to be a buy or a sell? How big is it going to be? And then with that, you could say, okay, well, we've got all these buys coming in, we've got all these sells coming in, and so in this moment right here, we should get an uptick. But then again, let's say in the moment there's a huge abundance of buy orders coming into the exchange that overwhelms the number of sell order inventory to take the other side of those trades, and the market starts to shoot up, but then some other trader somewhere in the world sees the opportunity to what he thinks is sell high and just slams that rally with a huge order. Now you would think, well, who could trade that big? Well, hedgers can trade that big because they're not taking the risk. They're eliminating the risk. They're already long or short. They're already what I call naturally long and short based on their business. So yeah, they can put that big of an order in the market and actually defend a price. You heard words like defending a price? This is what it means. You tell me how a mathematical equation is going to predict that. Somebody please. But that's exactly the way you trade, isn't it? Isn't it that exactly the perspective in which you take? You think that this mathematical equation is going to accurately tell you every single time what the intent of all these other traders are around the world? It's just a probability game, everybody. That's it. And analysis makes us think it's something else because of the erroneous connections that we make and erroneous assumptions that we make. It's like, yeah, okay, I've said it again. I did my analysis. I made a prediction. The prediction was absolutely correct. So the reasons why I made the prediction must be the same reason why the market went in my favor. And that way, I knew what was going to happen. I knew what was going to happen. Making us think that the risk cannot exist. if you're trading to avoid being wrong, if you're using analysis to avoid being wrong in any capacity at all, even just the tiniest bit, if you're using analysis to avoid being wrong and avoid losing, it doesn't work. The only way you're going to make this work is to adjust the way you think, is to change your perspective, that what you're doing doesn't have anything to do with, you're going to need, your predictions have to be correct, but your reasons for making the predictions do not. In most cases, for the typical screen-based trader, most of the trades they put on, there is virtually very little correlation between the reason why the market went in their favor and the reason why they put on the trade. Very little correlation. And what do I mean by correlation? How would I find that out? I would have to be able to inventory. If I went long based on a moving average, and my moving average crossed, and I put a buy order in the market, and and then 3 or 4 minutes later the market started rallying, and I'm thinking that, okay, that's well, I have the right reason for making this. My technical reasons must be be correct because it made the correct prediction. I would actually have to go out and determine all the traders who put buy orders in the market that actually caused my trade to become a winner, because I couldn't make my own trade become a winner. I can't trade at a level where, for an example, if and there are a lot of traders who can, a lot of traders who have strategies to do exactly this. Okay, that when they see how many bids and offers there are at certain price levels, at certain significant reference points that they know they might be able, like I said yesterday, like stampede people out of a position or even into a position that helps them out. Okay, all they have to do, if the price is at 10, all they have to do to bid it up to 11 is just simply take out all the offers. If there's X number of offers at 11, all they got to do is hit them. That's it. And the price automatically goes to 11. Then all they have to do to get it to 12 is hit all the offers again. That's it. They're actually creating their own price movement. They know why the market's moving. They know why it's moving because they're doing it. And they are making their own trades winners, because everyone who took the other side of their trade at 11, when it gets bid up to 12, is a loser. Everyone who took the other side of their trade at 12, when they bids it up to 13, is a loser. Now, this can be a dangerous strategy. You have to have a lot of capital and a lot of balls, because as their position size grows, for them to get out of that trade, what do they have to do to get out of that trade? They got to reverse everything. In other words, they have to become sellers, which means that if they have a huge position that they built, a huge long position they built up, there has to be buy inventory for them to get out of that position. In other words, they become sellers, and if there isn't enough buy inventory for them to get out of that position, they can actually force the price right back down again. That's what they, well, hey, yeah, it's like, right. There's a very famous guru on TV. I'm not going to mention his name, but about 6 or 7 years ago, he was doing an interview on the street, as a matter of fact, and kind of bragging actually before he became really famous. And he talked about a strategy, and this is something it's probably still done. I don't watch the markets enough to really say, but it's like if you watch to see what kind of orders are flowing, the size of the orders that are flowing into the exchange towards the close. So let's say we've been in an uptrending market, and it's like retail traders who need the most confirmation. They're the most risk adverse, so they need the most confirmation that something's going to work. Okay, so to get into a trade. So this is a particular stock, for example. So they see a lot of 50 share, 100 share, 200 share orders flowing into the exchange on the close. What do they know? They know a lot of retail people are buying into the whole idea, right? So what they're going to do is, they're going to see what kind of bids and offers are lining up before the close or before the open the next morning. And he would say, hey, you know what, depending on the stock, he might have to allocate, anywhere from $30 to $50 million to to take out all of the bids. So let's say the market is slated to open right here. He might allocate 50 million or whatever it took to take out all the bids to drive the price down in the open at the open. And all those, not all, but many of the people that bought on the close the previous day, this was the close the previous day, they're going to think, oh my God, what did I do? They're going to start selling, okay? Their sell orders are now going to help create this downward movement because there's an imbalance between the number of the buys and the number of sells. And as soon as they start coming into the market with their sell orders, he reverses his position and starts taking the other side of those sell orders as a buyer. So he was able to get in on this trending market, for an example, at a lower price. So you just force the market lower, he gets in at a much lower price, and then the market just reverses back up again and keeps on going. This is a valid strategy that people have been using for years. I mean, this doesn't surprise anybody, does it? So it's like you got to be able to do this. You got to be able to do it. You got to be able to get yourself into an emotional state of mind, like a person who's playing a slot machine. It's like, how do I lose without feeling like a loser? Real simple. You're not losing. This business requires expenses. Now, you're laughing, but it's true. You think that's the way? You think the casinos, the board of directors and the management of casinos, when they're looking hand by hand, they're saying, "Oh my God, we just lost $1,000. Oh shit, we just lost $5,000. What am I going to do here? What am I going to do?" These are expenses. The amount of money that we pay for the trade, the edges that don't work, is simply the cost of doing business to make ourselves available for the trades that do.